Welcome to Growth Investing Mastery. This video will look at my June 2026 growth stock portfolio review. As a reminder, this channel is not investment advice or recommendations. These are just my opinions, and the channel is completely independent. The purpose of this video is to review my growth stock portfolio at the start of July 2026. I will examine my portfolio changes and individual stocks in depth. I'm looking to focus on finding the most promising growth stock names. Let's jump right into my allocations at the end of June 2026. My highest allocation name is Astera Labs at 14.8%. This is followed by Credo at 11.3%, and then AppLovin at 11.1%. I have Silicon Motion at 10.5%, Kulicke and Soffa at 10.4%, and Micron at 9.4%. Two more positions I have are Pattern Group at 8.5%, and then Iren at 7.3%. Next, I have some medium confidence positions with Reddit at 4.5%, FIGR Technology at 3.9%, Cohu at 2.6%, Ethos Technology at 2.4%, and ACM Research at 1.8%. That's followed up by four starter positions. I have Hinge Health at 0.5%, ChipMOS Technologies at 0.3%, Allegro MicroSystems at 0.3%, and Toyo Inc at 0.3%. And lastly, I have 1% in foreign listed technology stocks. And I'll get into what those names are later in the video. One thing I wanted to note with my allocations is that my top 8 stocks make up 83.3% of my portfolio. What this means is that my portfolio is still relatively concentrated, even though I have 17 stocks and some foreign listed stocks additionally. Let's take a look at the portfolio changes I made on the month. I ended up re-adding 3 different companies that I've owned before. These include ACM Research, Allegro MicroSystems, and Toyo Inc. And then I have 2 totally new stocks with Hinge Health and ChipMOS Technologies. I added or increased my position in Silicon Motion, Kulicke and Soffa, Micron, and FIGR Technology. And I trimmed significantly in my largest position with Astera Labs. That was mostly because they had such a big run-up and not because I lost any confidence in them. However, I did trim in 3 positions where I lost a little bit of confidence. These included Iren, Ethos Technology, and Credo. I also bought and then sold back 3 companies in the month. These included SanDisk, Optical Cable Corporation, and Lumentum. Lastly, there was no companies sold since the last month, and I think that's a first for me in one of these reviews. The other move I made that's worth mentioning is I increased my foreign stock account to 1% of my total portfolio. So its portfolio is all the way down for me. Taking a look at my results. In 2026, I'm up 62% year to date. And if I look back at prior years, in 2024, I was up 146%. In 2025, up 112%. And you can really start to see the power of compounding here as I'm up 62% year to date, which makes the cumulative return since the start of 2024 being up 745%. But it's important to keep in mind that my results are not a straight line up, and this is a high variance approach to investing. If I look at the year to date point in time returns, in January of 2026, I was up 4% at the end of January. But then at the end of February, I was down 16%. And March, I was down 20% year to date. However, April started a strong recovery where at the end of April, I was up 11% year to date. At the end of May, I was up 50%. And then at the end of June here, I was up 62% year to date. It's worth mentioning as well in 2025, at some point in the year, I was down 26% before recovering as well and then ending up 112% on that year. Let's now take a look at my market and portfolio commentary. And I wanted to discuss one way in which my strategy is balanced. And this is that my strategy allows adding to a stock that is moving up or adding to a stock that is moving down. Adding to a stock that is moving up aligns with strong technicals and momentum trading. Many momentum traders use the trend as your friend strategy. And this strategy is sound both in practice and in theory. If I look at adding to a stock that's moving down, this lines up with getting a better value on the stock. But there's a big caveat here that this only works if I have conviction in the business and the financials. If there's a stock I own that's moving down and I do not have confidence in them, it makes it impossible to add to them. Usually that scenario only happens in a newer starter position that I simply do not know enough about. I'll give a few examples how this works in practice with adding to a stock that's moving up or adding to a stock that is moving down. So I'm fine to start a position in Hinge Health that's hitting all-time highs every day. But I'm also fine to re-add to Ethos Technologies as the valuation compresses and I have confidence in the business. Another topic that I wanted to get into is how it's important to think in ranges of outcomes with growth investing. The future is unpredictable, which might sound really obvious, but I need to take that into account with my strategy. There is a really easy trap for a growth investor to fall into right now, and this is trying to predict when the AI cycle may end. There's a really tempting thought for every investor. If I can simply figure out when the cycle will end, I can exit early. But the reality is nobody knows how long the cycle will go for or when it will end. And my strategy is fine with any outcome in that range, so no adjustments are needed. I'm fine if the AI cycle ends next quarter with revenue hitting a wall. I would end up exiting positions and paying the toll on the share price. And the cycle continuing for a long time is obviously fine, as my current stocks continue to benefit. And I wrote here, should I be worried if my portfolio crashes over 50%? One thing I want to keep in mind here is the larger the edge I have, the faster the recovery as well. And this shows the importance of an investor building an edge in the market. Another key point to keep in mind is that a company which can grow in a bear market is the most superior of all companies. That company will do even better in a bull market or when the economic conditions improve. I'm also not worried if any particular stock underperforms. This just frees up cash for another opportunity in a different stock. Jumping into the individual stocks in my portfolio. My highest allocation position is Astera Labs with symbol ALAB. The company makes next-generation AI networking hardware. Their custom silicon designs are the highest margin part of the supply chain. And there's lots of innovation in this name, which I like. Astera looks to avoid one-off designs, and they're aiming for designs that will work across multiple customers. The stock price for ALAB has seen a really big increase over the past 2 months, as the stock was around $100 at the start of April, and now it's approaching $500. But it's worth keeping in mind the year-to-date return is closer to 200%. And the stock was getting beaten down earlier in the year, while photonic stocks were pushing all-time highs earlier in the year as well. It was a bit ironic in the sense that Astera Labs has the potential to intercept the photonics opportunity. And that word intercept is their word there for management, as they've talked about enabling their Scorpio switch for photonics. I've seen some noticeable changes in management, describing the technical capabilities of the systems and upgrades. It seems like they're going into a whole lot more detail about the technical capabilities on the earnings calls. And the open source standards such as UA-Link, which Astera is a promoting member of, are the way that gives AMD and Amazon a chance to compete with NVIDIA. Additionally, the management team started getting more specific on which programs they're working with. The Scorpio switch is used in AMD's MI500 and Amazon's Trainium 4 chip. And this further confirms what the team has been hinting at for years with their design wins, in quotes. I view it as practically a best case scenario. It is these two programs with AMD and Amazon, where the Scorpio product is involved. I ended up significantly trimming my position in Astera Labs, mostly because not doing so would have resulted in a 20% plus position right now. And my next highest allocation position was around 12%, so I thought it made sense to diversify some here. While the valuation is worse, the company has a clear roadmap through 2029. And I still believe the company is on track for a $1 trillion or more market cap in the coming years, as I think it's a real possibility that Astera Labs could eventually reach the scale of Broadcom. The next company in my portfolio is Credo, with symbol CRDO. They make AI networking and connectivity hardware, and they are a peer to Astera Labs in the space. On this latest earnings report that Credo posted, the revenue and guidance came in lighter than I was expecting. I mentioned I was looking for the current quarter to get more than $455 million of revenue, but it landed at $437 million. And on the guidance, I was looking to see Credo guide next quarter to over $515 million, but that range landed at $465 to $475 million for the next quarter. To be fair, management had warned investors a couple times that their quarter-over-quarter growth rates were unsustainable. But previously, the company had kept over-delivering versus those tempered expectations from management. So the question might come up, why not sell if both the current quarter and the guidance came in lower than I thought? Credo was heading into earnings as a very high confidence position for me, and now they're more just a regular high confidence or medium confidence position. In this case, the clear action with my strategy was to trim some allocation from Credo. But it still sounds like the company's product ramps are on track for the second half of 2026. And everything seems to line up with what they are saying narrative-wise. It's worth keeping in mind that companies like Astera Labs and Credo will have more quarter-to-quarter variance than a SaaS-based company. And there's likely to be some quarters here and there with these names that either surprise to the upside or to the downside. These company revenue ramps correspond to customer ramps, which could be unpredictable. One silver lining from the last report was there was a lot of talk about neoclouds as customers. And it would be really great to see Nebius or Iren as a customer coming up. My next high allocation position is AppLovin with symbol app. The company makes an ad tech platform that's expanding in the consumer space. I realized when re-reviewing the earnings recently that the company was talking a lot about a quite substantial model improvement. And the management detailed how the model improvement happened 2 weeks before their last earnings call, which was on May 6th. So this means the upcoming quarter is going to see nearly the full benefit of the new model. There was also lots of mentions in the last transcript on the strength of the April month. The management detailed how the gaming business is getting bigger and bigger. And when the CEO was talking about AI-based ads, he said the ones they're producing are really, really tough to tell they are built by AI. And one direct quote was, "The cost is exceptionally low relative to what a human-generated video would cost." Later, he detailed they're getting close to just plug in and get your video out of the box. A few key takeaways from me are the company's general availability of the consumer platform is live now, but I'm still waiting on the fun quarter. Management had promised investors a fun quarter back in Q4 of 2025. However, everything does seem on track since the platform's broader launch. My viewpoint is the stock price seems to offer a compelling opportunity, given there's been no run-up in share price recently. And there's a potential for the company to be able to give surprising guidance if the new platform is really landing here. My next portfolio company is Silicon Motion with symbol SIMO. They make memory-based controller products. The company was pretty quiet this month with no press releases or news. And they do like to stay pretty quiet on deal announcements and product announcements until they're ready. Silicon Motion's Mon Titan boot drives are contracted for capacity at both Google and NVIDIA. And while the product doesn't have a high average selling price, it gets their foot in the door for two of the largest AI programs. And when the company was discussing the larger Tier 1 customer volume, They said it's expected to ramp meaningfully in 2028. We've never been better positioned, the management team said. And I found it really encouraging the company has a clear line of visibility to 2028. Silicon Motion detailed in their latest earnings call how competition is stepping back from the edge market. And the company saw surprising strength in mobile. They detailed how there was 30 to 35% quarter-over-quarter revenue growth, and mobile grew over 140% year over year. I noted here the next earnings call is already sneaking up, which is tentatively scheduled for July 29th. I'm expecting the company to be able to provide impressive guidance going forward. They detailed how there will be a sequential revenue ramp throughout the entirety of 2026. I find the valuation to be quite reasonable for Silicon Motion. This is because Q2 is likely to be over $410 million of revenue and be GAAP profitable. With a market cap around $10 billion, the stock price has some room to run up if they can deliver results. Another high confidence position in my portfolio is Kulicke and Soffa with symbol KLIC. The company is a more recent addition to my portfolio. They're US based and they make semiconductor assembly equipment with operations in Singapore. One new insight I had was I noticed there's a lot of emphasis in their latest earnings call about new products and the competitive advantages they have. The Astera TW system was announced in late March, and this is for complex high current and reliability power. The launch of this Astera system lines up well with the timing for next quarter's results, potentially. Additionally, the company has a product called the ProMem suite of memory features. These are DRAM solutions that support both cost-sensitive DRAM and high bandwidth memory, which is a form of DRAM. One thing that really stood out to me on their last quarter was that memory shipments increased by 93% quarter over quarter. One direct quote was that they expect to gain market share in DRAM with their new solutions. And management detailed how they're continuing to invest in the R&D organization of the company. The company's thermocompression bonding, or TCB, is expected to grow at least 70% sequentially for the fiscal year. One analyst called out that the $400 million annual goal for TCB is 2 to 3 times the current capacity. Management detailed that assessment is correct and they're expanding their production capacity. From my perspective, that could lead to some upside in the stock price. The TCB solution was described as the best solution in the market, or as a very flexible system, they said. The company had their auto and industrial segments overperform in the last quarter. They also talked about how semiconductor content is going up in the auto industry. Kulicke and Soffa is another stock in the semiconductor industry with growth. And I think they have a pretty reasonable valuation here. But I could also see the stock flying under the radar for a bit from the market until they post their next result. My takeaway from the last earnings report was the stock could have easily gone to over $200 a share based on the strength of their last report. But it seems like it may take some time for that scenario to play out and for the market to appreciate this name. My next high confidence position is Micron with symbol MU. They are a US-based global memory manufacturer. I had a post on YouTube and elsewhere about Micron's earnings report, and I went in depth there on my thoughts. The one thing I didn't cover in my post was Micron's follow-up call. And they always have this second call they do, which is like an additional Q&A. In that second call, one analyst mentioned Micron's $30 billion free cash flow that's going back to shareholders. And the analyst followed up by saying this implies large share buybacks are coming. The management discussed how there's structural supply challenges, and HBM is soaking up more wafers. Micron is working on greenfield expansions for incremental wafer capacity, and they're aiming for a 75-25 split on DRAM versus NAND. The team detailed how they like the diversity of their end markets and they plan to continue supporting each. The company's SCAs, or long-term agreements, indicate the multi-year time horizon going beyond 2027. One direct quote was about the very high confidence demand from our customers, and these SCA deals cannot be canceled. The Tung Luo acquisition in Taiwan is adding incremental bits, and it's outweighing the startup costs right now. The management talked about the importance of their end markets, and they said if automotive only got 50 to 70% of their memory allocation, it would be a catastrophic problem. Another quote was, "General sentiment amongst customers is that we are very short of their demand." And they talked how they're doing everything they can to get their ID1 or Idaho facility and Tung Luo online for the upcoming ramp. I noted here they sounded apologetic practically, as if they're doing the best they can, but it's not enough right now. Later they talked about how enterprise SSD momentum is exceptionally strong. They said NAND is very constrained, but there's a sense of concern and urgency around DRAM, which is very, very high. My next highest allocation is Pattern Group with symbol PTRN. They're a platform for brands to grow via logistics and software. The company recently did a capital raise at $19 a share. And it's kind of interesting because the company is already profitable right now. So I'm wondering if they have an acquisition in their sight or some broader logistics expansion. And the stock was recently added to the Russell 3000 and Russell 2000, which should help the stock gain some more attention. The big standout from the company's last report, from my perspective, is their NRR was at 127%. This NRR number was surprising because they said the long-term target for this number is 115%. So it appears like the business is doing better than management expected. Other monetization strategies grew 173% year over year. And that grouping of other monetization strategies includes their SaaS offerings. International revenue grew 101% year over year. And the phrase management used is they're expanding where demand is shifting across geographies. There's improvements in the supply chain, leading to better one-day and same-day deliveries. And the company was able to lower their days of inventory, which was 62 this quarter, down 13 days from last year. R&D spend was up 77% year over year. And they talked how they're doubling down on tech spend, including AI token usage. I found it impressive the company was able to raise their full-year adjusted EBITDA guide to $200 million, which would be up 31% year over year. The company's previous guidance had implied 18% year-over-year growth in adjusted EBITDA. Management was talking on this latest earnings about the large TAM they have for the distribution of any digital goods. I mentioned when I first introduced Pattern Group on this channel that the market re-rating them as a software or SaaS business could be really beneficial for their stock price. And that seems to be playing out well as the stock price has more than doubled. But in a lot of data providers, Pattern Group is still classified as broadline retail. However, they are building a competitive moat with their logistics and SaaS offerings. My next portfolio company is Iren with symbol IREN. They are a neo-cloud with a focus on energy efficiency and data center build-out. There's been a meme going around with Iren about WEN deal, where WEN is spelled W-E-N. A lot of investors were looking for a new deal with a hyperscaler, but the deal that investors got turned out to be with the Golden State Warriors. Iren is going to be the official logo for the NBA team. This is also Silicon Valley's closest team. I saw the CEO was getting a lot of negative feedback on Twitter because of the timing of this announcement and the recent capital raise. And I also thought it would have been much better to make this NBA announcement in conjunction with a capacity deal. And I really didn't like this deal a lot, especially since on the last earnings call, Iren told us that NVIDIA is their best salesman and that they don't need a large sales force. So it does seem like another pivot in business strategy. And my overall strategy here is to trim for each action that I do not like from the management. However, I'm still a believer in the long-term strategy for this company. But I'll want to confirm my thesis is still playing out and seeing cloud revenue scaling up. One side note about my allocation in IREN is that it's in a taxable account. My shares lapped the 1-year mark in August, so I'm not too eager to trim that much further until I lap that period. And then I'm likely to do another round of trimming here. I did find this past earnings report challenging to evaluate as well, as their Bitcoin miners were being turned off. They did mention some of the capacity for the NVIDIA contract will be air-cooled, and this allows them to get the capacity online sooner. But on the other hand, this new facility for NVIDIA was supposed to be the flagship, so I would have expected liquid-cooled machines for this contract. As I was recording this video on July 1st, Meta decided to enter what seems like the neocloud space. And it sounds like Meta is going to rent out their excess capacity as they look to expand their own capacity as well. And it's worth keeping in mind Meta already has deals in place with CoreWeave and Nebius. My take is Meta wants to accumulate as much capacity as possible. Meta may still be looking to sign contracts with neoclouds, but it's hard to say for sure now. And that could be part of the reason that IREN is trading down recently as well. It seemed like Meta was offering every neocloud a contract, but that might not be the case anymore. Moving on to a medium confidence position in my portfolio, I have Reddit with symbol RDDT. They make community-based social media with an ad tech platform. The company was recently at the Bank of America Tech Conference, and they did an international tour in France. One thing that makes Reddit different is management said the older their account is, the more time they spend on Reddit. And they described how users age into Reddit, whereas on other social media platforms, users who've been around for a while are starting to log off. One of the most searched terms on Google is Reddit in quotes, and it's often looking for product reviews. Describing their company, the management said, "Our platform is lightweight and our company is lightweight." There's low OpEx for Reddit, and there's hardly any CapEx as well. The presentation material from Cannes, France, centers around new types of experimental campaigns. And there's now ways where upvoted positive comments about a consumer product can easily be turned into an ad. Some takeaways from me are that it's surprising in a bull market to see Reddit well off their highs. They did give conservative guidance, but I'm confident they will do well versus their guidance. Reddit has a unique value proposition in social media that may be hard to replicate. So I'm not all that concerned when I hear about Meta may have a competing product coming out. I wrote here that Reddit could be the last bastion of human-generated content in this AI world. And that's something management has talked about as well, that a lot of the value from Reddit comes from humans typing the responses. Reddit is a good case for me to apply the buy what you know strategy, as I'm learning more about Reddit from the moderator side. And if you want to have further discussions on growth stocks, the subreddit r growth stock investing is up and running now. My next portfolio company is FIGR Technology with symbol FIGR. They are a blockchain-based marketplace for loans. When I was reviewing the last earnings transcript, it read more positive than I was remembering. The team talked about adding whales, or companies which can do over 50 million of volume per month. And they discussed adding one partner in Q3 last year, which now did over 150 million of volume this quarter. Later, there were more details about these high-volume customers. They said the strategy remains focused on onboarding high-volume whale partners. With regards to guidance, the team said they're intentionally conservative with guidance on factoring in new partners. There was a specific case mentioned about Mutual of Omaha, which has volume growth. They are a Fortune 300 financial institution, and Mutual of Omaha did 5x monthly volume growth after upselling to the Connect product. FIGR Technology had an acquisition recently, which I believe is on the smaller side. The company is called Kiavi, and they do residential transition loans, sometimes abbreviated RTL. And FIGR is moving Kiavi's assets to the FIGR native blockchain. And they said this asset class will be the first to use fully agentic. There's agent-to-agent onboarding featuring Adapter. And it sounds like Adapter is one of FIGR's new AI products. My take is it's great to see the relentless pace of product releases and innovation coming out of this company. They seem to have a really strong R&D organization here. Some takeaways for me are that the stock price had gotten so beat up, I added as the market cap got well below $10 billion, and I like the risk reward here. The company has fairly limited exposure to crypto price swings, but the company's expansion plans benefit from Ethereum and Solana chains, so it's still good for FIGR if Ethereum and Solana are growing. My next company is COHU, with symbol COHU. They make semiconductor test and inspection products. In their latest quarter, revenue landed at $125 million versus a guide of $122 million at the top end. So the company beat guidance by a little bit, but next quarter is guided to $144 million of revenue, which would be up 35% year over year and up 15% quarter over quarter. However, the company's full year guidance seemed to imply the $144 million run rate is for the rest of the year. One analyst was asking about this guidance and if revenue really would remain flat for the whole year. Management confirmed their guidance is accurate, although I think they may be sandbagging a bit. Overall, I'm not too concerned about this guidance because the market has not boosted this name too significantly yet, versus how other semiconductors saw a sharp rise in stock price. For example, in the same industry, there's Air Test Systems, and COHU has 12 times the revenue, but the two companies have similar market caps. And that's in addition to Air Test Systems having a negative growth rate on their latest quarter in terms of revenue. Some standouts from the latest earnings transcript were that orders were up 57% year over year. Semiconductor test orders were up 163% year over year. And the company's high bandwidth memory inspection tools are new, along with recurring software revenue. Additionally, there was a multi-unit order for something they called New Silicon Photonics Solution. The team detailed how they're accelerating R&D and expanding production capacity. My takeaway is the market cap of around $3.5 billion seems pretty reasonable for this company. And I can see the stock working towards a $7 to $10 billion valuation if they can deliver over $150 million of revenue and give decent guidance going forward. The next company in my portfolio is Ethos Technologies with symbol LIFE. They make a life insurance platform for agents, consumers, and carriers. And the stock price has taken a big hit since reaching $30 a share after their earnings. Initially, I sold off a bit of my position as I didn't like how it was trading down seemingly daily. However, I did reevaluate later in the month to add back some shares. During my mid-season earnings review, the commentary from the latest earnings transcript seems strong and in line with my previous take. There were no press releases or related news for the month, so not a lot of huge updates from the company. The big question mark for me is still around the company's guidance. They landed at $193 million of revenue in Q1, but then guided Q2 revenue to be from $114 to $118 million. There is significant seasonality in Q2 for this company. However, it's not that much seasonality to have that big a quarter-over-quarter decline here. My take is management is being cautious on the guidance, being a newly public company. Q1 direct revenue grew 136% year over year, and third-party grew 42% year over year. It's impressive to see that new business line of direct really pushing the growth. and the company deepened relationships with Banner Life and a new partnership with Liberty Mutual. One item that is holding me back from a larger allocation is much of the company growth comes from sales and marketing right now. But I am expecting the sales and marketing spend to come down some as their name gets out there more. I do view Ethos as having a unique value proposition in a legacy-dominated industry. My next portfolio company is ACM Research, with symbol ACMR. They make semiconductor wafer fabrication equipment. In the latest quarter, revenue was $231 million, which is up 34% year over year, and they had EBITDA of $41.6 million, with net income of $17.3 million. Gross margin is 46%, and the market cap for this company is $8 billion, as the stock had a big run-up recently. There's an unusual situation here where ACM Research owns 70% of a Chinese subsidiary, and that subsidiary is also called ACM Research. It trades on the Chinese exchanges with symbol 688082.SS, and this underlying company or subsidiary is trading for over $28 billion market cap on the Chinese exchange. So the Chinese stock market is moving up the subsidiary regardless of the US stock price. And ACMR's roughly 70% stake is worth about $20 billion, well more than the $8 billion market cap of the US stock. I wrote here, is the market really pricing in a rug pull from the subsidiary? I think that's a really unlikely outcome here. It seems like a tremendous opportunity to me, as the gap between the subsidiary and the parent is just too large. Some bigger takeaways about this company are they have new product cycles, including a technology called our vertical furnace product. Electrochemical plating grew 3 times year over year and was a primary driver of the revenue growth. The company is accelerating their R&D efforts, and they have a fully experimental R&D line, which has been in operation for some time now. The company did have some pull-through revenue from Q4 going to Q1, so this may have inflated Q1's numbers a little bit. And I want to be cautious that I'm not overestimating them here. Getting into my starter positions, I have a company called Hinge Health with symbol HNGE. They are a healthcare app for joint-related issues, and they've got an expansion to mental health. Revenue had been guided from 171 to 173 million previously, and that landed at 182 million in the latest quarter. Adjusted net income had been guided from 30 to 32 million, and this came in at a pretty big beat with 46.2. Additionally, Hinge Health raised their full-year guidance significantly. Previously, the 2026 full-year guide was in a range of 732 to 742 million, and the management team was able to raise that to 798 to 804 million. Adjusted net income was previously guided from 151 to 156 million, and the updated guidance put adjusted net income in a range of 205 to 215 million. This new guidance implies the future quarters in 2026 will see a step up versus expectations. Many times companies raise guidance pricing in the current quarter's beat only. But in this case, the guidance implies a large step up in their business prospects. However, I'm still a skeptic on the company's plans to do contract manufacturing for a physical device that treats migraines. I'd like to know more about margins for this device and the company's longer-term strategy, as I thought their edge in the market was from app building and relationship building, as opposed to getting into medical devices. Another concern I have is the lack of information on Medicare Advantage plans. The company has a small percentage of revenue coming from Medicare Advantage plans, but they don't disclose how much. And I felt the company's 10K filing was intentionally obtuse about Medicare with their strategy here. My next company is a new position called ChipMOS Technologies with symbol IOMS. They're based out of Taiwan and they do semiconductor manufacturing taking orders from fabless companies. Revenue in the latest quarter was $217 million, which grew 35% year over year. They had EBITDA of $54 million and net income of $16 million. But the gross margin for this company is just 14%, which is pretty low. However, the range over the past year is from 9% to 14%. So they are at the upper end of the potential range recently. The market cap is $2.1 billion with a run rate price to sales of 2.5. The company does assembly and test with an impressive customer list, which includes Micron, Nanya, and Phison. Their process includes wafer probe, assembly, and the final test process is their specialty. But they don't do circuit design or wafer fab, and this is part of the reason they have a lower gross margin. The top 5 customers make up 61% of revenue, and the percentage breakdown of the top 3 customers are 23%, 15%, and 9%, but they didn't disclose who those top 3 are. I do find this company to be a bit unfriendly investor-wise. There's no transcripts through my data provider, and they only do an earnings call every half or every other quarter. I gathered most of my information on this company from their yearly filing, but they do give monthly updates on overall revenue numbers and growth. One concern was the May month was minus 3% month over month and only grew 17% year over year. I plan to track their monthly numbers, especially what they're posting in June coming up, because I want to confirm it's not multiple weak months in a row. Another drawback to this company is they have $407 million of debt via bank loans, but it sounds like the interest rate they have on these loans is pretty reasonable, from 1.5 to 2%. And since this company is GAAP profitable, they should be able to pay it back over time, but it might hamper their expansion plans a bit. Overall, ChipMOS Technologies is a low confidence position, with the main 2 reasons being the lower margins and the growth rate. But I still found them promising enough to take a starter position here. My next small position is Allegro MicroSystems, with symbol ALGM. They make sensing and power integrated circuits. I re-added this name as a small starter, and I'm interested to see how the next report looks. The prior report numbers were just okay, but below my expectations. I saw this name starting to move in tandem with robotics hype, and I remember the company has good upside exposure to a large TAM with humanoid robotics. Their industrial segment grew 38% year over year, driven by data center and robotics. Robotics itself doubled over the past year, but it's still a small base and not driving overall revenue that much yet. And the company was discussing design wins they have with humanoid robots. I still have pretty low confidence in this company, but I had been thinking to take a small starter position on their earnings day, as the company is on my earnings calendar. The transcript reads like they are doing well, but they have not delivered that standout earnings report yet. But since I saw the stock moving up and getting some market attention, I decided to reinitiate a position. Funny enough, the next day on July 1st, it was down about 15%. Overall, the valuation for Allegro MicroSystems is not super cheap. And I still think companies like Silicon Motion or Kulicke and Soffa seem like much stronger opportunities overall. The last company in my portfolio is Toyo Inc, with symbol TOYO. They are a Japanese solar cell manufacturer that's scaling up in the US now. And I did get back in here with a small starter position. Shortly thereafter, the stock price went down pretty fast, more than 50%. The company did a capital raise of $50 million, which seemed to me to be very straightforward, or ABC. The $50 million raised was stated to be used for their Houston facility build-out, and it was done at $11 a share. But for some reason, the stock started trading down to $8 and getting as low as $6.50 recently. However, the company had $28.4 million of GAAP net income last quarter, so I'm not too concerned with them running out of funding. So the bottom line from my perspective was the stock dropped massively on the news of the capital raise, but I saw no issue with it. Toyo is one of the cheapest companies I've seen in a while. They have a run rate price to sales of 0.44. And the reason I have some small amount of confidence here is they expanded really quickly from their original Vietnamese facility. They scaled up in Ethiopia, and now they're building directly in the US. And the Ethiopia facility got to a full 4 gigawatts per hour scale in about 1 year. It uses robotics, so they were able to scale up really fast. The company has aggressive expansion timelines, and it's part of the reason I don't want to be on the sidelines here. One potential yellow flag is the company appointed a new CFO, but the transition sounded normal. The new CFO has strong ties with investment banks, and it sounds like they're planning to try and expand their potential investor base. I do see Toyo as a company that has some elevated risk, though. There's a Japanese parent company which owns a lot of the shares. So this isn't a super straightforward story, but I do like the risk-reward here. Let's now take a look at the foreign listed technology stocks I have, which make up 1% of my portfolio. I'm up to 6 names in total now. One nice advantage here is I'm learning more about the global semiconductor market. So I might be building up some small, subtle edge here, learning more about the supply chain and such. But there is a pretty big trade-off to having a sub-portfolio like this. And those trade-offs come in the area of concentration, focus, and cognitive overload potentially. But I find it really interesting and fun to track down some of these foreign names and make some investments here. There's 2 new names this month since my last update on this sub-portfolio. The first is Nanya Technology with symbol 2408.TW. And they're a DRAM-based fab out of Taiwan, but they have no high bandwidth memory exposure. This company has a great client list as SanDisk and Kioxia are customers, and I learned most NAND finished products require some DRAM to them. I think the Taiwan location could be a benefit for this company, as they're next to other companies in the supply chain, and there's no shipping costs. Revenue in the latest quarter for Nanya was 1.54 billion USD, and that was up 583% year over year, and up 61% quarter over quarter. The company had 816 million of net income in the latest quarter, and a gross margin of 68%. Analysts are already projecting the next quarter to have a 47% quarter over quarter increase in revenue. However, it does sound like Nanya is hitting some production capacity, and I think their expansion plans may take years to materialize. The company does have English transcripts, and they attend tech conferences, making this one of the more accessible names. Another company I added is called Innodisk with symbol 5289.TW. They make industrial SSDs and DRAM modules, and they're a fabless producer. This company is mainly a numbers story for me, as they have some incredible earnings numbers on their last report. Revenue was 413 million, which was up 403% year over year, and up 170% quarter over quarter. Net income was 171 million, with a gross margin of 59%, and a market cap of 4.8 billion USD. Analysts are projecting a 34% quarter-over-quarter increase in revenue on their next report. In addition to these 2 new names, I now have 6 names in total. And those other stocks are ADATA Technology with symbol 3260.TW, SmartOptics Group with symbol SMOL.OL, Transcend Information with symbol 2451.TW, and Phison Electronics with symbol 8299.TW. I put this little infographic on the right side of the screen, and that shows my holdings in order of allocation in this sub-portfolio and what exchange they trade on. One company that I bought and sold in the month is SanDisk with symbol SNDK. I keep going back and forth on this name. The company is a NAND memory maker, and I've been getting hung up around the expansion limitations around this business. The company's joint venture with Kioxia forbids them from initiating their own expansion. Additionally, the company relies on Nanya for DRAM as they're not able to produce DRAM themselves, and their assembly and test is done primarily in China. It's maybe a fairly small risk, but I see SanDisk as particularly vulnerable if there's some supply chain disruptions in Asia. And that's a bit different than Micron or SK Hynix, which are more global, and they can expand on their own with a wider array of products. But the reason I'm so conflicted here is because NAND prices are rising, and this company's financials are amazing. The company recently reached no debt, and they have $3.7 billion of cash on the balance sheet that will only be growing. Management has mentioned buying back their shares. My sell decision here really came down to the opportunity cost. It's just easier for a smaller name to make a big run-up percentage-wise. But on the other hand, I could easily see SanDisk running up to a $1 trillion or more valuation in the coming years. I am getting more memory exposure by owning Micron and Nanya. I'm also thinking of starting a position in SK Hynix, so I'm not quite sure I need to own SanDisk. Another name that I bought and sold on the month is Lumentum, with symbol LITE. They make optical solutions for the data center. And I still see this company as a great name that I like a lot. And the price has come down significantly from the all-time highs. My decision for selling here mostly came down to preferring smaller names in the semiconductor space with more potential upside. One concern I have with this company is on their indium phosphate supply. But they are opening a new fab in North Carolina to produce more of this material. That fab is still a long way off from providing supply though. And I wrote here that I wouldn't be surprised to see the market way overreact on a supply blocked quarter. This month I reviewed the JP Morgan, Bank of America, and Mizuho technology conferences for Lumentum. And these sounded really promising. The team said this cycle is way different than previous market cycles. They called it a multi-year run, or an AI supercycle. And they discussed at these conferences how they're dropping some of their lower margin products. I also see their optical circuit switch, or OCS, as a big innovation in the space. At the Mizuho conference, they were saying that OCS is not seen in their numbers yet. And there's a lot of other products that are scaling up too, which aren't seen in their numbers quite yet. And I would add that I'm likely to be back in this name at some point. Lumentum seems like a compelling opportunity that could be a top position in any other market. The last company that I bought and sold in the month is called Optical Cable Corporation, with symbol OCC. And they make optical cables, if you couldn't guess from the name. Their latest quarter had a step up in revenue at $22.2 million, which was up 27% year over year. And they had net income of $1.1 million, so the company is profitable right now. The gross margin in the latest quarter was 34%, and this somewhat indicates lower innovation with their products. However, I thought it was interesting that this company still has higher margin than Applied Optoelectronics. But I think Applied Optoelectronics has much more of a technology roadmap. The market cap for OCC is pretty reasonable at $180 million. And it's a run rate price to sales of 2. The company is increasing sales to enterprise, data center, and what they call the severe duty markets. Some of their cables are made to be durable and used by the military. In many cases, it's a third-party buyer, and the end customer is unknown for privacy. These are likely government projects. There's a newer partnership with a Japanese company called Lightera. The partnership started roughly 9 months ago, and the two companies are working on a shared roadmap and product lineup. Optical Cable Corporation measures their backlog, and their sales order backlog is just $13.3 million, or less than their quarterly revenue right now. However, I thought this seems like a company where backlog is not the greatest measure for their business, because it seems like some of their sales are on demand. And this is what I meant by a lack of technological roadmap. But maybe that is being addressed more with the partnership with Lightera. One bigger concern I do have is that revenue got up to 26 million back in 2018. And it was sort of a high watermark for revenue, but revenue growth has stalled since then. I'm wondering if this company is content with their production capacity. But there was one part in the transcript where they said, "We're not seeing any limit on our ability to grow in the markets that we're targeting, particularly in data centers." There's also zero analysts covering this business, and there's no guidance, so it's a really rare scenario. There's simply no metrics to gauge against where the next quarter might land. But I did add this company to my earnings calendar. I want to see what they can do next time around and if that data center market is really taking off for them. Let's take a look at some promising new ideas I found on the month. The first name is Marex Group, with symbol MRX. They're a financial services platform for liquidity and risk in energy, commodities, and financial markets. Revenue in the latest quarter was 1.12 billion, which grew 55% year over year, and they had net income of 112 million. Gross margin was 62% in the latest quarter, and the market cap is 4.6 billion. They do keep the financing of these instruments on their own books, so they have 12 billion of cash and 13.1 billion of debt. And this company actually benefits a lot from volatility in metals and energy. Companies are looking to hedge their risk for markets such as gold or oil. One big drawback to this company is their corporate structure is a bit weird with a relocation to Bermuda. They're based out of the UK, but they're listed on US exchanges. And apparently this is a regulatory or compliance nightmare for them, so they're trying to find a way around it. The next company that I took a look at on the month is called Market Electronic Hismetler v Tickeret A.S. or commonly called Hepsiburada with symbol HEPS. Okay, I just wanted to say the full name out loud there. This company is a Turkish e-commerce platform. Revenue in their last quarter was 521 million, which grew 61% year over year. Net income was negative 22 million, so the company isn't profitable yet. Gross margin was 25%, with a market cap of 1 billion and a run rate price to sales of 0.5. The company's delivery services grew 47% year over year, while ad services grew 38% year over year. And the company's Hepsi Pay product grew 6.7 times year over year. So it sounds like that product is ramping up. One interesting fact about this business is that Kaspi owns 65%. And Kaspi is the e-commerce retailer from Kazakhstan. They plan to use Hepsiburada as their distribution layer, building what they call a super app. I've been following Kaspi for a while, which has the symbol KSPI. And I plan to keep checking in on Hepsiburada and Kaspi if there might be a good entry point for buying stock in one of these businesses. The next company I looked at is called Liftoff Mobile with symbol LFTO. They are a demand and supply side ad platform and a competitor to AppLovin. The company is a recent IPO, and in their latest quarter, they had revenue of 206 million, which grew 37% year over year. EBITDA was an impressive 108 million, and the company has a net income of 49 million. Gross margin was quite high as well at 86%, and the market cap is 4.7 billion, giving them a run rate price to sales of 5.8. The biggest standout for me is the company already has impressive profitability, with GAAP EBITDA being over 50% of revenue. The one big concern I have is that Blackstone has over 50% of the voting power for this company. And the company has debt of 1.82 billion, which is very large in comparison with their market cap. When I was looking into this debt a bit, it sounded like Blackstone encouraged this business to lever up. And I really don't like how private equity likes to add a bunch of debt to the books. Let's take a look at some more promising ideas. Another name I looked at is SK Hynix with symbol SKHY. They're a soon-to-be listed ADR for the memory giant from Korea. Their most recent quarter had $35 billion of revenue in USD, which was up 60% quarter over quarter and up 198% year over year. Analysts are projecting over 58% quarter over quarter growth in revenue next earnings, and net income was an impressive $28.6 billion. I think SK Hynix probably has more innovation than Micron, and they have a faster expansion ramp with more capacity coming online sooner. It's for this reason I'm planning to initiate some position when the ADR goes public, but the challenge is going to be finding another position to cut. Another company I looked at on the month is called 5N Plus, with symbol VNP.TO, and they trade on the Toronto Exchange in Canada. They make specialty semiconductor wafers, refined metals, and compounds. One of the compounds they make is gallium, with end markets for space solar power, medical imaging, radar, wireless, and LED-related products. Their latest quarterly revenue was $118 million, which grew 33% year over year. The company is profitable with net income of $17.8 million, and adjusted EBITDA grew 41% year over year. Gross margin is 32%, and the market cap for this stock is $2.65 billion USD. There was an interesting move with the management team. The CFO recently became the CEO in a planned transition. So now there's a new CFO as well. The valuation for this business seems pretty reasonable. One more company I checked out in the month is called Keysight Technologies with symbol KEYS. They do electronic design and test, which leads to simulating, validating, and manufacturing processes. Revenue came in at $1.72 billion in the latest quarter, which grew 31% year over year. Net income was $349 million, with a gross margin of 63% and a market cap of $59 billion. The run rate price to sales is 8.6, so it's not super cheap. Some standouts from the transcript are that orders grew 56% year over year, and earnings per share grew 69% year over year. The company's operating margin is 30.4%, and that grew an impressive 520 basis points year over year. The company detailed how there's strong adoption of new ultra-high density interconnect solutions, and they're expanding their optical portfolio as well. Keys does sound like a good opportunity with a reasonable market cap, but they did have some acquisitions which I view as a minus. And the market cap is already larger for this name, so I'm not sure there's quite enough upside from my perspective. Let's have a look at a couple more promising ideas. One name is Sterling Infrastructure, with symbol STRL. They do electronic infrastructure, make fab buildings, and support transportation and building projects. The work is broken down by data centers accounting for 64%, transportation is 23%, and buildings are 13%. And transportation here means things like rehabilitating roads, bridges, and airports. Revenue in the latest quarter was $826 million, which grew 92% year over year. EBITDA was $165 million, with net income of $96 million. Gross margin is 24%, which seems fairly low for this company. The market cap is $27.4 billion, giving it a run rate price to sales of 8.3. So this business does seem fully valued to me already. My concerns fall into a few categories here. One is the low margins, and the company indicated they do not raise prices. I also thought they might be engineering constrained and have to grow through acquisition. And I do view this market cap of $27 billion, showing that the market has fully appreciated this name already. However, there is a pretty big TAM for this type of work. Another company I checked out is called Silicom, with symbol SILC. This is an Israeli-based company that makes hardware for high-performance networking and data infrastructure. Revenue in their last quarter was $19.2 million, which grew 33% year over year. But the company's not profitable yet, with EBITDA of negative $2.4 million and net income of negative $2.4 million. Gross margin is 30%, with the market cap being $267 million. That gives them a run rate price to sales of 3.5. The management described their business as having extraordinary momentum, and there was a Tier 1 cybersecurity partner that selected Silicom's edge systems for their next-gen products. While the company is not profitable yet, the market cap is low compared to the potential, from my viewpoint. Let's take a look at my final thoughts for the month. The market seems keen on boosting specific AI niches on any given day. So sub-industries like photonics or memory got their month in the sun already. But I view it as being good to stay diversified and not just pile into the hot subsector. The market's likely to overreact to the upside, but then cool off fast. So it makes sense to have some memory exposure, some photonics exposure. But an approach which goes all in on photonics or all in on memory is likely to be stressful. And that gets back to the point of having a balanced strategy. And I want to have different growth names to have some diversification, even within AI as well. I also view it as healthy for my portfolio to have names outside of AI. This helps lower the variance or luck, and it helps to smooth out results as well. I view building a sustainable approach as key. One last point I wanted to make is the market having some days where tech goes down huge is healthy for the market. And July 1st was one of those days where the market sold off tech and innovative stocks very fast. But overall, that helps to prevent a real bubble from forming. This concludes the video on my growth stock portfolio review. As a last reminder, this channel is not investment advice or recommendations. The content here is just my opinion, and the channel is completely independent. Thank you for taking the time to listen to this video.